3, 2, 1. Welcome to the show.
Welcome to the show. We are 5 months into the year. At first, I thought we're
I don't even know what date it is.
6 months, but man, we're the year is flying by.
I don't want it to fly by. Last year it flew by. Well, felt to me like it flew
Last year
by.
was it's Groundhog Day. Last year it was crazy.
Was, yeah.
But it is Memorial Day, almost. The Memorial Day weekend show. Sounds like a Jimmy Buffett. The Memorial Day weekend show. That is the Jimmy Buffett thing. Yeah. And to go along with that, we have a quote from Franklin Delano Roosevelt, 32nd U.S. President. Those who have long enjoyed such privileges as we enjoy forget in time that men have died to win them. So,
Well, that's a pretty uplifting quote.
it's Memorial Day, bro. You gotta memorialize, right? You know.
We do.
Yep, we do. Regardless of the side, the political side of the spectrum that you're on, we get to put on the show and do the things we do because our buddies are still out there.
They are. Yeah, and we've both lost quite a few friends, so I'm definitely not making light of it. It's just,
Yep.
dark sense of humor.
That's how it works. That's how it goes.
When you're a cop and a soldier. Yeah.
Yeah.
Sorry.
Yep. All right. That was Memorial Day. Let's move on. The show this week. All right. Investors Business Daily. We've talked quite a bit. Is this all right? This audio? Sounds weird to me. Talked quite a bit about Investors Business Daily, and I read it every day. I've been reading it really every day since I probably just got out of college. And sometimes I kind of conflate what I think and what I think I read in IBD. It's kind of interesting, but we're gonna get into some of that. But we're gonna hit three things from Investors Business Daily. Their rule number one, similar to my rule number one, is don't lose money. They say it in a little bit different way, but they're gonna show it. This is cut and paste from their website. Why rule number one is don't lose money. And so the second piece is going to be how to spot a market top. So it's relatively easier anyway, to spot a market bottom than it is a market top, especially in the last couple of years. It seems like the bottoms have all been V bottoms, and they've been really easy to spot. But spotting a top is much more difficult.
Yeah, it's definitely not a V.
No.
It's usually like 90 degrees.
Yeah.
Or close, 45.
Yeah. So basically, like I've been, we've talked about it. I've been doing a lot of work to try to figure out some better indicators that can help us get out at a top without having to take a big down dip before we do it. And so that's kind of what I've been focusing on. Yeah,
and the reason we have to do that at least at this point until we find a few more indicators, right, is just because you have to confirm it's a downtrend. We can't guess, because then you're out. Then you got to get back in.
Right.
So you need confirmation. What we're looking for, I think, right, is faster confirmation.
Yeah.
And with still the same high probability.
Yeah,
We're not giving that up. We're not going to start guessing.
No, absolutely not. Absolutely not. I mean,
you're looking for high probability indicators that, might be just a tad
right
on the front end.
Right. There was some talk in the last couple of days in the Facebook group about if you go to the G fund, if you go to the G fund now, what would get you back in, right? How would you know when to get back into the stock funds? And as I was kind of thinking about that question, I can answer it in terms of moving average lines and things like that, but unless the market moves, unless price actually moves and hits some of those lines, when would you get back in? And so right. I found sort of an answer to that question in IBD. Yeah.
All right.
And then we're going to go over, I think we did it a while ago, but the IBD's ETF market strategy. It's a very simple way if you wanted to, and we're going to talk about how to apply it to TSP, but if you wanted to be in the market when the general trend is up and be out of the market when the general trend is down, this is a good way. You'd have to subscribe to IBD, but it's a pretty good way to do it. Then we get a bonus chart. We didn't do it last week, but we're going to do the bonus chart this week. Grayscale Bitcoin Trust. there is a lot of analysis in that chart that we're going to look at. A lot. So hopefully
I like it.
Y'all's eyes won't roll over in the back of your head, but it wouldn't surprise me
if you have interest in crypto and you have interest in ways of getting into the crypto game without necessarily, if you want to do it in the normal industry standard way with a Fidelity account or Schwab or TD, whatever, like these are the kind of ways that you do it.
Yeah, there are very few of them.
Yeah, and Grayscale is probably one of the more stable, well established.
Yeah, it's been around since the beginning. And you can't buy it. We'll talk about that, but you can't buy into Grayscale right now.
Got to buy it in the secondary market.
Yeah.
But Google Grayscale, check out their stuff. If you're into crypto, it's a really good kind of way they're doing it. Yeah,
it's good. We're going to get to it at the end here. And then, of course, the daily charts. Okay. So this, I didn't make any of this stuff up. This all is basically quoted from the Investors Business Daily articles that I was looking at this week and links that I went to. It's all inside the IBD world. But the title of this one article I was looking at said, still the number one rule for stock market investors, always cut your losses short. And this is very similar to what we talk about all the time, the math of investment losses, right? So if you consider the math, you buy a stock for $50, for whatever reason, it drops 8% to $46 over the next couple of days, and you promptly unload it and move on. To get back to even, to reclaim that loss, you need to make an 8.7% gain on your next purchase, right? With the remaining capital, which 8.7% shouldn't be that hard to make. But what if you hold on, right? You're sure you bought the stock at 50. You're sure, for whatever reason, whatever your analysis says, that the stock is worth 100. So why would you get scared out by a little setback of 8%? Right? It's down to 46, no big deal. It'll come back, and I know it's worth 100. So why would I get out? Only problem is the market doesn't care who you are, what you think, how much you believe in a stock. The market has told you, so you may not have miscalculated, but the market is telling you that at least in the short term, you have miscalculated. And that message gets louder, right, as the stock drops to, say, 37.5, which is a 25% drop, right? Now to get back to even, you need a 33% gain with the money that you have left in that stock. So much tougher to make a 33% gain than the 8.7% gain was, right? And now if you really are stubborn and you stick to your guns and the market doesn't like your stock, cuts it in half, now your stock's worth $25, and like it says kind of sarcastically, you don't need a calculator to figure out that one. If you take a 50% loss, you need a 100% gain on what's left. And how many stocks did you pick last year that doubled in price, right?
And as we talk about this all the time, and it's for some people, it is the hardest thing for them to wrap their head around because it goes against so much conventional wisdom that we hear, which means buy and hold works and, blah, 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 blah. It's not that it doesn't work. It's just that if you have the opportunity and you have confirmed a trend, all the things we talk about, and you can get out and not take that loss, then you don't have to you don't have to make a 100% gain or 8.7 or anything, right?
The one thing it doesn't say here, which kind of surprises me for these guys, is that if the stock goes down 25%, it's not coming back 100%.
Right. We're not talking, but we're not talking indexes either.
Yeah. Right? No, but this is for stocks. This is for picking stocks. But the concept is the same.
It's gonna. If it does come back, it's gonna be a long time.
Yeah, for individual stocks, if ever.
Yeah, if ever, right?
Yeah. When was the last time you saw Amazon take a 25% haircut? It doesn't happen.
No.
But AMRN, whatever, the one we did a couple of weeks ago. That most stocks are much more volatile. If you're lucky enough to buy the FANGs when they were young, and they were still doing 25% haircuts, and you hung in there. I mean, that kind of buy and hold is, it takes a lot of fortitude to stay in the trade. But Yeah, anyway. For this, it applies to stocks, but for us, it's the same kind of idea. You can't put new money in other than what you're putting in every payday. So cutting losses short for us is even more important.
Yeah, as it reflects in our balance.
Yeah,
and that's what I use. I don't. I think you've said something similar to this. Like I don't look at my rate of return.
Yeah,
I look at my account balance. Yeah. That's what matters to me.
Yeah.
I don't want to go around bragging that my PIP is this and my rate of return is that. And if anything, I would like to brag about, it's my Sharpe ratio.
Yeah.
Right? My low risk choices. Yeah. Because at the end of the day, as long as it
keeps
moves up,
moving up,
I don't care. Yeah. It doesn't have to skyrocket.
Yeah.
I need it to move up. That's what I need it to do.
Right.
And understanding that philosophy and that kind of a way of approach, goes a long way to managing a retirement account. Yep. We're not talking about managing anything else normally.
Right.
We might use things as examples, but what we're focused on retirement account, which I would treat very different than a brokerage account.
Yes, definitely. I do. I have both, and I treat them very different. Yeah.
Yep.
Literally, sometimes I put a different hat on. Yeah.
Goes from a baseball cap to a scally cap.
Yeah. Okay, so little pictogram from the IBD site about that. If you're digging a hole, your initial loss is 8%. You need to make 8.7% return on what's left. And on down there, if you take a 50% loss, you need to make 100% gain on what's left. And it doesn't happen very often. So something to think about. Okay. How do we know that the market's at a top, but what are some other indicators that can tell us that the market's at a top? So we always talk about, we have moving average lines, right? And we can see where support levels are expected to be, right? But when the market's going up, I have one chart here, and we did on the alert this week for the iFund. If you can draw a top channel line, you can extend the price up to that top channel line. And then you can say, okay, I expect it to hit it and probably reverse down. Because if you have a channel, it hits the top trend line, reverses down, hits the bottom trend line, comes up, right? So now you're in the channel. But if you don't have a really good channel like that, how do you know how high the market can go before it's going to roll over? It's much easier to trade the bottom almost on trend lines than it is on moving average lines than it is to figure out how high the market will go. And this goes to the question about when would you get back in? If you go to the G fund today, how would you know when to get back in if the market keeps moving up? So here's what IBD kind of says about that. IBD looks at professional selling. And so a distribution day is a significant decline on the NASDAQ or the S&P 500, right? So again, this is not TSP, but the NASDAQ and the S&P 500 are well, the S&P 500 is the C fund, but they're big indexes. So a distribution day is a significant decline on the NASDAQ or the S&P where the decline is on higher volume than was seen in the previous session, right, the previous day. So IBD defines a significant decline as a drop of more than 0.2% with no rounding up. So 0.2% or higher in price. And the distribution day indicates usually heavy selling by institutional investors, the heavyweights who largely set a market's direction. So what the key piece of this is a significant decline in price on higher volume than the day before, right? And so a significant decline, like they said, is more than 0.2%. The reason you get the significant decline is because of the heavyweights in the market. It's not me and you selling individual stocks. It's big institutions. They call it leaving footprints. That's how you get big volume days. And that's what IBD kind of tracks. So 4 or 5 big distribution days over several weeks almost always signals that stocks have topped and are heading for a downturn. So we're going to come back to that again in a second. But that, I underlined that and I bolded the part above it that was not highlighted like that in IBD, but it's the part that I was trying to emphasize. 4 or 5 distribution days over several weeks nearly always signals that stocks have topped and are heading for a downturn. So what's an easy way to keep track of distribution days? Of course, this is their sales pitch, but there's a section in IBD that's called the big picture, and it's accompanying graphic, which I have on the next slide. It's called the market pulse. It makes it super simple to watch the count. Every day of a rally, the market pulse lists the number of distribution days, right? Which is the sort of the number that we want to know. With the big picture offering an interpretation of the market's latest action. So there's a bunch of narrative in there in the big picture, but the market pulse really gives you all the information kind of in one place. So IBD's research has determined that investors shouldn't count distribution days after 25 trading days have passed. At that point, those distribution days, those days of liquidation have become irrelevant. So the market can have a bad day or 2 bad days, but if enough time goes by, those days kind of become irrelevant. So what that kind of means is, if the market's going up and then it starts going sideways, and it had a couple hard sell-off days, but then recovered and didn't get to new highs, but another hard sell-off day, didn't get to new highs. Those are examples of institutional selling. But then if the market starts creeping back up and making new highs, even if it's just incrementally, if enough time goes by, 25 days, the value of the pull on the market subsides, basically. So they after 25 days, they knock that day off. So a distribution day falls out of an index's count after the index climbs 5% above that distribution day's close. IBD has developed this rule on the premise that when an index rallies and extends itself from a distribution day, it's showing the strength to overcome high-value selling. So if it can get back above 5% above where it was on the distribution day, it's considered that the market was strong enough at the time to absorb and sustain that distribution day, right? So where are we right now? This was the close on Thursday. The market pulse comes out kind of late, 8 or 9 o'clock. It comes out kind of late in the day, every day. This was Thursdays. So uptrends under pressure. See if my pen works today. Nope, it doesn't work. Uh-oh. That hasn't happened before. Can you see that?
Yeah, we're good. I can see it.
No, I can't see it.
Yeah, we're still looking at the slide.
Are you seeing?
Nope.
Seeing that slide? No.
I think you might have locked up. First time we had technical difficulties with the PowerPoint. Go back to the show. Broadcast it.
Yeah, I can't.
All right, reboot. Hey, guys. I wish I had a camera pointing just at me so you didn't have to see Jerry sweating right now. He's getting the slideshow figured out. But one of the things I will say, and I was going to talk about this anyway before that happened, was we are looking at so we've been talking about this performance page for a while, right? And we know that a lot of people want us to have one, particularly people who aren't members, because they can't see everything that members can see on our site, and so they might not have, as good of a picture, right, of performance. But performance means a lot of things, and for us, it's important for us to make the performance, any kind of performance indicators that we come up with, we need them to be relevant to our methodology, right? What do I mean by that? So simple rate of return does not take into account as much of our methodology, because we're getting out the same thing that Jerry just explained. Out, market keeps going down, we're back in, when it starts coming back up. But everybody else had to write it down. Now they've got to get, like Jerry said, you're going to need 100% to get back to where you would have been. And we've talked about all these numbers, right? So that's one piece. So simple rate of return, PIP certainly doesn't work for us because my PIP is not your PIP versus this person's PIP. But back to the IBD kind of pulse thing, this is a very generic way of saying it's on a general uptrend, it's on a general downtrend, it's market under pressure.
Yep.
Those kind of, there's really only three ways the market goes: up, down, and sideways.
Yep.
And even so, we're not talking about taking anything away from the site, but adding some performance indicators for us, particularly risk-adjusted rate of return, but also this kind of concept of here's where the market is going, and not just on the performance page, but more of like on the member dashboard.
Yeah.
And there might be some use to that. We're still trying to figure out. First of all, we got to make sure we don't copy
step on anybody's toes. Yeah,
because we're not getting sued for copyright. Yeah. We want the general idea of it, but we do not want to copy theirs.
Yeah.
So
we're
back at the market pulse.
We're back. Okay. I really like this because it makes it very simple, and I know a lot of people don't want to get as involved in all this technical analysis stuff. And so if you're looking for a really simple way to do it, this is a good way to do it. You would have to subscribe to IBD, which if you want to learn about, IBD is a great newspaper anyway. So if you want to learn about this stuff, it's not all that expensive. Subscribe to IBD and read it. This market pulse piece. So we talked about how 4 or 5 days, where was it? 4 or 5 distribution days over several weeks nearly always signal that stocks have topped out and are headed for a downturn. As of Thursday, right, we are 6 distribution days on the S&P 500 and 4 on the NASDAQ.
What does that mean, Jerry?
I'm going to show it on a slide. I thought I had, let me see something here. I do, right there. This is the current, we're going to come back to this as when we talk about the ETF market strategy, but this is the current direction that you would see. And it changed on May 12th. So if you guys remember, anybody who's a subscriber to the site remembers, on May 7th, I think it was, IBD, or we did an alert, right? Jerry BD did an alert. And of course, as you know, my alerts have to come out before noon that day. Yeah. Well, it always supports helps me, whether I'm right, quote unquote, right or not, when I put out an alert, and it gets confirmed later that night when IBD changes their market direction, right? Yeah. So I was very happy to see that on the 7th, I think it was the 7th, IBD had changed their market direction. That was a Friday. The Monday, the market exploded back up and we had to get back in. IBD also got back in. They changed it to confirmed uptrend that Monday night. Right? But then on the 12th, it rolled over and they have been in market under pressure ever since. We were basically in market under pressure, essentially, right? We looked at it a little bit differently because we have to take into account the TSP rules, but we were essentially in market under pressure. And then once we got back, or at least I was thinking about it that way, once we got back up to even and we had some more of these distribution days and we were close enough to the end of the month where it wasn't going to matter if we moved to the G fund because prices weren't going to go that much higher, then we put out the alert this week to get out. I mean, that's there's a whole lot going on in there to come to that, but that's where it is. So as of today, actually, IBD is still in market under pressure, and it has been since May 12th. Okay. And we still have 6 distribution days on the S&P and 4 on the NASDAQ. So
now, just as a recap, we're talking distribution days, and if we were looking at a chart, that means a high volume day.
It means, yes, it means a high volume day. You have to have at least a 0.2% price move down on either the NASDAQ or the S&P 500.
With big volume.
On big volume. Big volume bigger than the day before.
Yeah.
That's institutional selling.
All right.
And so we've had 6 of them. And their rule says that 4 or 5 over several weeks nearly always signals stocks have topped out. Yep. We are definitely there right now. Now, it doesn't mean that the market's going to roll over and crash. But if you want to, if you are a conservative investor, if you want to protect your retirement investment, you will look at the market pulse and say, okay, we have more than 5 distribution days. The market's going sideways. We got seasonality issues pushing at us because it's the beginning of the summertime. All these things are going on, and we know we're on a 5th leg higher in the Elliott wave. Mm-hmm. Like there's so many things.
And we've been talking about these for weeks.
Yeah.
I mean, not to pat ourselves on the back or anything, but there's also members. This is what makes me happy. A lot of times, a lot of things make me happy, but this does make me happy when I see members make comments on either our blog post or they'll email us or whatever, and they say things like, you know what, I'm looking at all these things and I'm out or I'm in. Yeah, yep. Usually it's out, yep. Right? And I think to myself, thank you, because now you're actively managing your TSP account, yep. And you're saying to yourself, I don't want to. I'm not going to sleep well tonight unless I pull out and put it in G, and I'll ride this out and we'll confirm what's going on, and then I'll get back in, and yep. It's fine. Yep. But at least my retirement account will not take a dip, right? And if it does, it's going to be a small dip, because that's what all of us should be thinking is like my retirement account. I don't want it to go down.
No.
If it goes down 1% or 3% or 4%, to wait for confirmation, that's something that has to happen sometimes, yeah. Right? I'm not talking about that. I'm talking about these 10, 15, 20%. Yeah. And we know it's coming. We don't know when, right. But we know there's going to be a dip coming. I mean, they're saying it right there, not just us.
Right. So now, what could happen here, right? The market in the summertime tends to be volatile. Doesn't always crash, but tends to be volatile. So what could happen? Over the next 25 days, these distribution days could fall off. We could get to July, and there could be 1 or 2. The market pulse could read, markets in a confirmed uptrend.
3 and 2.
2 distribution days on the S&P and none on the NASDAQ. Like, right. Could easily read that.
Yeah.
And then
those days will fall off.
Yeah, because they'll fall off. Yeah. So, and it's almost like what we talked about before, like I don't think we talked about it on the show, but one of the things we were talking about was how if the market is more than, say, the price is more than 5% above the 10-day moving average, how high can price get above the 10-day moving average before it rolls over and hits the 10-day and comes back up, right? Those are the kinds of things we're trying to figure out to get us out closer to a top, right? If we got out there at a top like that, it doesn't mean the market's going to roll over and crash. It just means the 10-day needs time to catch up to the price. So it's the same. They're saying the same thing. It's just in terms of distribution days. It doesn't mean the market's going to crash from here. It just means that there's so many distribution days over that time that the risk reward, it's not worth being in the market. That's what they're saying. Okay. I really like IBD. Great stuff.
I'm coming to like it. I will warn people. It's like anything else that has so much that
it's overwhelming.
You can get overwhelmed. What you need to do is take the stuff that we're talking about and kind of find your lane in there, right? And the stuff that makes sense to you. Don't get bogged down in the overload of information. It really is inexpensive for what it gets. If all you did was buy a subscription just for the market impulse, the market pulse,
yeah. It's
worth it.
So if you are thinking about it at all, the best one, buy the one. It's the Monday. They call it the Monday issue, but it comes.
By the way, we're not getting paid by IBD or anything.
I wish I was getting paid by IBD.
I just want to make that clear.
They could be our first sponsor.
If we ever pitch something, trust me, it's just because we use it.
Yeah.
We're not. Yeah.
Yeah, that's a good point. On the weekends, it comes out either Saturday morning or late Friday night. So call it Saturday morning. It's like the weekly wrap edition of the IBD. Get the newspaper, not the electronic version. Go down to the store, go to the Giant
That's
or whatever.
That's the cheapest way.
It's like, I don't even know how much it costs, to be honest. I get the online version. But the best way to do it is go down, get the print version on Saturday morning and read it over the course of the weekend. You'll get the direction, the market pulse, and a ton of stuff. Half of it you don't need because it's basically numbers. It's not as bad as the Wall Street Journal, but it's basically numbers. But there's so much awesome information in IBD. Once a week, it's definitely worth it.
All right, IBD sales pitch over.
Yeah. Okay. All right. Last part of IBD. So if you want to use, they have a methodology here, right? They call it their ETF market strategy. So IBD's Market Pulse feature has a long history of recognizing market shifts in direction early and helps investors maximize gains in uptrends and protects portfolios in downtrends.
That sound familiar?
Sounds familiar. That's what we're trying to do, right? So they developed this method for trading indexes based on market direction posted daily in Market Pulse. Kind of exactly what we're trying to do. We only have to worry about three CS&I, three indexes, right? So this is how they say it works. You buy an ETF. In this case, they use the QQQ is the NASDAQ. You could call it the C fund or the S fund or the I fund. It really doesn't matter because it all works the same. So you buy one of these indexes immediately after a new uptrend is announced in Market Pulse. So for us, for example, that would be like when you hit the 50-day moving average on the C fund and you get support there and then it pops higher. Right? Buy the C fund then. Let's just say, right? Buy the C fund then. So you'll see in if you buy it when a new uptrend is confirmed, buying it means you're in it 100%, right? As time goes by, when IBD puts out market under pressure, you would sell half of it, which for us means move half of it to the G fund. So in this example, and I'm not saying you should do this, I'm saying it's a very simple way to do it. If you only use the C fund, let's say, then when IBD says we're in a confirmed uptrend, you reallocate to 100% C fund. You watch it every day. When IBD says we are in uptrend under pressure, you move to 50% G, 50% C. When IBD says market's in correction, you move to all G fund. That's it. It's very simple. You would absolutely miss the big down moves using this. You also won't catch the bottoms. It's the same sort of criticism that we get for not catching the exact tops and bottoms. You would have the same thing here. But it's a very simple way to do it and ensure that you're not going to get clobbered in kind of like what happened in COVID. Okay, that's all I got for IBD. They should be hitting us with some cash, I think, for that. Yeah.
I will say that again, we talk about how there's plenty of ways to play this game, right? Yep. And you just shared a tool that if what we're doing is too much in and out,
yep.
that's another way to play it. Now, you're not going to get the returns that you would really want doing that, but it is a very risk-averse approach.
Yes.
And, I'll point out that IBD charges a subscription to get that, right?
Yeah.
That's exactly what we do. We try to keep it at a price point that's low enough that it's not a barrier,
yep.
right? But the idea is that we're giving you the information you need.
Yeah. Yeah, I mean, the way they come up with their uptrend under pressure or confirmed, we're a confirmed rally, uptrend under pressure or markets in correction, they have decades of and floors full of analysts and everything that are coming to the conclusion of markets under pressure.
They got a lot of people to figure that out.
Yeah.
It's not just one guy sitting in front of his computer.
Right.
Yeah.
Right. So,
but it is, again, Jerry mentioned this, and I'll brag on him a little bit, but by and large, when we've made some significant moves out or in, by that night, when IBD puts their information out, it a lot of times it's most of the time it's confirming what we did, at least in the in the broader sense of what we did. They're not going CS&I, F&G, like they don't have all those going on, right? They're talking about being in, being partially out, or out.
Right.
That's really all there is. Yeah. So
it's very simple though, because as they point out, they call them footprints. Like when institutional selling happens, you can't not see it.
Right. Yeah. It's leaving footprints.
The only thing that I have to do is try to hope that the footprint is for real and happens before noon.
It holds true. Yeah.
You know what I mean?
Yeah. And IBD and these guys are not held on 2 moves.
And they don't have the 2-move a month rule. Yeah. Yeah. No, that's a very big deal.
All right. Moving on.
All right. Grayscale and the bonus chart. Okay. So here is Grayscale Bitcoin Trust. As you can see, Grayscale Bitcoin Trust placement is currently unavailable. So what that means is you cannot go to the website and buy any of their products. And if they were available, you would have to be
accredited investor. Yeah, and not only an accredited investor, but most of them have limits like $50,000 minimum. All these different things. Which we don't talk about this a lot on our show because it's usually not relevant to our folks. But most folks don't understand what it takes to get into these private equity, to get into these kind of things that are not what everybody sees. An IPO, like. An accredited investor is basically someone making over $200,000 a year, has a certain level of education and investments, and the reason that they're allowed to do it and we're not, we could, because we're educated and we could show that we're accredited. Doesn't necessarily, it's not all about the dollar figure that you make, but that's a big part of it. Because you have money to lose and you're kind of educated. Yeah,
theoretically, you're a sophisticated enough investor that if you're going to take the losses, what the risks are and all that.
Right, and most the average person doesn't understand the risks, so we don't want people getting hooked by snake oil salesmen. Right. And that's the whole.
This is the government protecting us against ourselves.
Yes, exactly. But the cool thing with Grayscale, as I'm sure you're going to get into, is there's a way to get into that. Though.
There's a way. The Grayscale has probably 10 or 15 different products in there that are all Bitcoin or crypto related. But there is and this particular product is the Grayscale Bitcoin Trust. This one you can still get into, like Conan said, in the secondary market. And so,
can we get secondary market real quick, just in case people? So that just means that some big investor, some rich person like Jerry buys from Grayscale, they were lucky enough to be able to buy a bunch of this, and. So what they're then allowed to do after 6 months, I think, is their rule. I can sell it. I can
offer it to
in the secondary market, which just means a place like Fidelity or Schwab or whatever will hold those and allow us little people to buy it, but not at the same prices.
No. Yeah,
but that doesn't matter. The fact that you can get in the game is okay.
Yeah, and the cool thing about this is, like we said, Conan was saying earlier, it's one of the few. It's not an ETF. It's a trust, but it tracks like an ETF. But it's one of the few ways that you can get in on the crypto game, without having like a Coinbase wallet or whatever like that.
Right, and so me being a tech guy, I'm not scared of using a blockchain or getting involved in those exchanges and doing. That doesn't scare me. Yeah. What bothers me is I don't want to do it like a brokerage account. I want to do it in my retirement account because I'm trying to build my retirement account, not necessarily, there's things that I'm doing on this other side, but my main focus is my retirement account. Right. As we're both in that same kind of thing. So I want to be able to buy it with my retirement account, with my IRA, and this you can.
So I bought this in my Fidelity account.
Oh, I own it.
Yeah. Oh, yeah. Yep. I bought it. Let's see. So basically, what happened was, the answer to the question real quick is I bought it right there. And why did I buy it?
Tell us why. Yeah, okay. That's the important part.
This is the important part. So there's so many things in this chart. I had to do my own list on the side to keep track of what it all was going to be.
A lot going on.
A lot going on. Try not to let your eyes roll to the back of your head. The trust had been basically flat. Even if you look back here, it's basically going between $10 and $15 all the way back. At some point here, it gets above 15 and then pops. All right. So we get a 1. Then we get a 2. Right, Elliott wave. 1, 2, big 3, a 4, which didn't get lower than the top of the 1, right? Because otherwise it invalidates the count. Then we get a 5. And we get, in the big scheme of things, we got an A, B, C. Okay? You got that?
Yep. Oh,
all right.
Yeah. Track it.
How do we know that ABC is a correction, consolidation, and not like a complete collapse in the thing? Because we know that the impulse waves are 1, 2, 3, 4, 5, and consolidation waves are 1, 2, 3.
ABC.
ABC.
Yeah,
ABC.
either way.
So you got within, so you had A, B, C for B, right? You got one move down, and you get ABC, which gives us a B. Then you get ABC, which gives us a C. So they're all three leg moves. Once you get used to looking at it, you see it. The 3 leg moves are corrective. They're not impulse moves. So you got ABC, you got ABC. But the bigger one was ABC. So they're moves within moves, right? But there are no 1, 2, 3, 4, 5s in there.
Right.
They're all corrective moves.
That's the takeaway.
That's the takeaway. There's no impulse moves. They're all corrective moves, right? And you got C finishing at the prior 4. Because if you go back and look at your Elliott wave cheat sheet, you would see that the correction usually takes you back down to, the C usually comes back down to the same level as the prior 4. Okay? All right. That's Elliott wave. Moving average lines. You got the 50-day moving average line. The trust price was getting support at that 50-day moving average line since it got above it, and we started tracking this thing on the one leg. Every time it came back, tested the 50, tested it until it broke through the 50 right there, right? So the 50-day moving average line was really useful until it broke through right there. Now it's down to the 200-day moving average line, and it just so happens. All right, there's moving average lines. It just so happens that the 200-day moving average line is right at the 61.8 retracement level on the Fibonacci retracement. A two leg, which at the end of the day, this is going to be 1, 2. The 2 leg tends to correct back to the 61.8% retracement level.
Yeah, and those retracement levels, if you guys aren't used to using or haven't played with that in whatever chart software you're using, those will do themselves. You just got to kind of find out where they need to line up. So you don't have to do the math, and there's not a lot of Fibonacci calculating.
No, you just pull it across.
You pull it across and make sure it lines up where it needs to be. And there's a little more to looking at, but I don't want people to think that you broke out the abacus.
I didn't pull out the abacus.
Yeah, it's those lines are built in there already in the tools that you have in the chart software.
Right. What I did was I put a dot right there at the 10, and I drug it up to the top right there.
Yeah, exactly.
That's all I did.
And then it's going to show you where those other 3 are.
Yep.
That's it.
It puts them in there.
You did a better job of explaining that. But it's just a drag. It's like a copy paste, drag and pull.
Yeah, it's very simple.
Yeah.
And if you go to the tools in, I'm pretty sure with a free account you can get them. I don't think you have to pay for those tools.
I don't pay for that, so it's there.
It's there.
So we got Fibonacci.
Volume. You got huge positive volume, right? The black volume lines go on the up move of this. The 1 and the 3, the 3 especially. Then the up days kind of dwindle on the 5 leg, which you would expect because it's starting to peter out. Then you got relatively light volume when price first starts coming down, and then really big volume into the final C wave. Right? It doesn't mean it's not going lower from here. It's just that all these things add up to say that we are probably pretty close to a bottom, if not at a bottom right there. You got RSI lower than it's ever been over here, which you could argue is a bad thing. It's also starting to turn back up.
Turning back up, yeah.
And the same thing with the MACD. So, and I from a fundamental perspective, like I don't think I think crypto is only going to get bigger and more important, and I really think that at the end of the day, this is a 1-2, and it's going to explode higher from there.
Yep, which means we got a 3, 4, 5, which I point that out because you're going to have a 4.
Oh yeah,
right?
There's going to be a 4.
That means there's going to be a downtrend. So what's good about crypto at this point is some of the crypto, particularly like this, where we have access to it, right? For our retirement accounts, we have access to it, and we've got charts, we've got time. That's something that like a lot of people, because they don't pay attention to that, they just pay attention to
the price of Bitcoin.
Well, they just pay attention to the TV and the hype. Is they're not looking at any sort of real analysis, whether it's fundamental or otherwise, which I would argue it's very hard to do fundamental analysis on crypto.
It's tough.
I mean, if you know how, write us a memo. Tell me how. But technical analysis, once you get enough time and price movement, now we can start putting in these kind of tools. Yep. And so if you're interested in crypto, if you have no interest in it, don't do it.
Yeah.
Don't do it.
It's volatile.
It's volatile as hell. I only do it because I'm a nerd and I like the underlying technology behind it. I didn't get into it until things started moving in a way. Jerry and I got in pretty much the same time. I probably got in a week before he did. And watching the same things, right? And I've got my lines in the sand drawn.
Yep. Oh yeah.
I know where I'm getting out. I know where I'm getting out. I don't know where I'm getting back in because it hasn't happened yet. Yep. But I know where I'm getting out. And so even if you don't like crypto, all of this that we just walked through though is very applicable to just about anything.
Everything. Yeah.
So that's really the bonus chart takeaways, right, folks? It's not that we're trying to tell you to buy. I don't remember the stock you were talking about. Oh, you did Peloton one time.
Peloton, AMRN.
Yeah, and in crypto, we're not telling you to buy these things. That's not the point. We're giving you insight into things that we're doing outside of TSP as a way to give you these tools that see, hey, they don't just work in the TSP.
Yeah,
they work.
They're the same. It applies to everything. I mean, the only reason I bought this, I mean, everybody's talking about crypto, so that was kind of on my mind. But when I looked at the chart and it was down, it had ticked down through the 50% line, the Fibonacci retracement level, and was almost at.
I can almost guarantee you, Gary, it's a new guy. Jerry didn't care anything about the Bitcoin technology. No. He saw the chart.
Yep.
And he's like, absolutely, bingo.
Right. Yep.
Bingo.
Yep. I mean, it's funny. The one other thing I forgot to kind of mention was you can see B right there is below 5, right? So you hit the 5, and you get A, B, C, which gives you B, which is a lower high, right?
Yep.
Then you got this big move down, the recovery back to the 10-day moving average. It can't get above it, and you get the second big move down, and this move is the same length as this move. So AB equals, it's called AB equals CD. But
we got to get our little Elliott Wave cheat sheet on the main site so people can find it quicker, because that comes in handy when you're doing this. I have to always refer to it. I have not memorized these rules, and I always ask Jerry to second guess me, check my math.
It's
You get better at it.
You see it after a while. You see it. So like this length right here is the same as that length right there.
And it doesn't have to be like exactly.
No.
Right? Because you do that and people are like, wait. I see it's a little longer. That's not the point. The point is, generally speaking, when you draw it, you make it look easy. Right? But when you're looking at it without your drawing, sometimes it doesn't stand out. The more you do, get in there with a pen and paper.
Yeah, play with it.
If you have to. Or if you've got an iPad or something you can draw on a tablet like Jerry has. And do that. Play with it and go, oh, well, that didn't work. Let me draw this one. Oh, yeah. And keep looking at the rules, right?
Yeah, the rules work.
The checklist.
I mean, the Fibonacci extension stuff, like you know that one, right? The 3 leg is theoretically 1.618 times the length of 1. So I'm not sure exactly what the length of this line is, but it's a little bit longer than this one.
Yeah, right.
It's 1.6. Is it 1.618? I'm not sure.
It's close enough.
But it's close enough. Yeah,
it's close enough. For Fibonacci's.
Yeah, 5 is generally the same as 1. I don't know. You got to look at the rules. It's like riding a bike. After a while, you get good at it and whatever.
Yeah.
All right. Oh, I forgot. We're not done yet. Okay, the daily charts.
I thought you forgot something about grayscale.
No, I forgot. I was thinking we were done.
No, we always got the daily charts.
I forgot about the daily charts.
I'm looking for some music to play as a segue to the daily charts, but I haven't got it yet.
Oh, yeah, that's right. All right. C, S, I, and F, because the G doesn't have a ticker symbol. All right. So before we get into the regular 6-month daily chart, this is the C fund 2 months where each tick is 30 minutes. Okay. So we were talking about how there was a bit of a head fake, and that was the head fake. When we got back in on the Friday, I think it was the 7th of May, that was the head fake. And the next day, the market rolled over and tanked and kept on going down for a couple of days. That's what it looked like on an intraday basis. The blue line here it's 117. So right there it says 117. That means it's 117 30-minute sections. It's that moving average. And it roughly corresponds to a 10-day moving average, which is why I have it in there like that. So we put out an alert at the beginning of the week that basically got us out of stock funds and into the G fund. Why did we do that? There were a lot of reasons, but for the purposes of this chart, right here, I should have went back a little bit further, but right there you see we're starting to get support at that 10-day moving average line. And then we have some explosive moves higher, right? We're going to show it on the 6-month daily charts, but you have what you want to see out of support at the moving average lines is explosive moves higher. And once we got above, this was a big day. It got us back in, but it was a head fake. And then once we got back above the 10-day, prices have been kind of dribbling higher. It's just not inspiring confidence. You're not seeing the kinds of things like you saw back here, like explosive moves higher off the 50, off the 10-day moving average. And even more interesting, which was really kind of the point of this chart, the volume, right? This was Thursday's close. The last 30 minutes, that volume, that huge up volume, was the very end of the day on Thursday. And then this up volume, or down volume, was the very end of the day on Friday. So what's happening? You can see price at the very end of the day on Friday. Price rolled over pretty good, quite a bit. What does that mean? Institutional investors do not want to go into the next day holding the C fund, holding the S&P 500. Everybody's selling it at the end of the day. It's bearish. It's definitely a bearish sort of symptom of the market. You got this high right here, this high and this high. So if we can't get back above this high, which we very well may not, I mean, it may not collapse, but we may be doing something like this for a while. The market's the price is just not moving like it would like this if this was just a minor kind of consolidation thing. All right, so that's intraday. So here's where we are on a 6-month daily chart. We pointed out that we keep getting support at the 50-day moving average, and we have support here at the 50-day moving average. What we don't have this time, back here, we had some explosive moves higher, right? Once we had the correction, we had really explosive moves higher. Here we've basically, prices dribbled up, and we still haven't gotten above the prior high. And this day, what looks like an up volume day is a fake up volume day, because all that volume happened right here, and it happened on a 30-minute down note at the end of Thursday. So if you look at this and you go, oh, we had a huge big volume on a price increase. Yeah, the price was a reversal day. The price did finish higher than the prior day, but it was a reversal day and big volume. So really, that was a negative day. You just have to really understand what you're looking at to see it. It was not a big volume up day. It was really a big volume, what should have been a negative day. You get the RSI basically flat, and MACD can't push above it, and price is dribbling higher, but it's not inspiring confidence. It's not explosive moves higher like that, which is what you want to see. S fund, same kind of thing. It had a little bit more support off the bottom there. We're still not seeing big moves like this, right? We're not seeing big explosive moves higher. I fully expect the S fund to roll over. Whether or not it makes it up here, I don't know. But I'd be amazed if we see, something above 2250 before we see 2050. I'd be amazed. Could happen. Now that I said it, it probably will, but I would be amazed. iFund, kind of like what we were talking about before, if you can draw a trend line on top that's valid, right? So at the beginning of early January 2021, we hit a top. And then we had another top, so you could have connected the lines there. Then we got this top, and now we just reversed on Friday off of the upper trend line again. So we always since the beginning of the year, we've gotten support at the 50-day, right? If you're looking at this channel, chances are the market comes down, gets support at the 50-day, and goes back up, right? But we got out at the beginning of the week right there because we're at the top of the channel line. So could the market go higher? Could the iFund go higher from here? Absolutely. But every time it's hit this level, it's rolled over since the beginning of the year. So it's not worth the risk as far as I'm concerned. F fund. A little bit of chatter in the Facebook group about the F fund, and why do I think the F fund is the best chart? It's still the best chart. All these other charts are topped out or
on their way to
on the way. Yeah. The F fund is the only one that's just had a big drop. So this is going to be basically the 0. This is going to be a 1. This is going to be a 2, and we're gonna do like this. That's my primary count. I'm not saying we're going to do that. I'm saying that is the Elliott wave pattern that seems to be playing out right now.
Right, and we've seen in the past, and it holds true usually, right? If the stock funds start turning over, what happens to the bond fund?
They don't work inversely, but they don't they don't work the same either. So it's possible that the bond funds can go up when the stock funds go down.
Yeah. They don't necessarily. They probably aren't going to go down together.
Yeah, they don't. Yeah. They don't correlate really. They don't. See, the thing that I think is interesting about the F fund is everybody's talking about inflation, right? If inflation means the interest rates go higher, right? If the bonds are as the yield, what your return is on the bond, as yields go higher, meaning rates go higher, the price of the underlying bond goes down. So if what we're tracking here in the F fund is the price of the bond, not the price of the yield. So when you hear on the news that yields go up, on the one hand, it's good if you're buying new bonds because now the rate of return you're getting on those bonds is going up. That's good. But if you already own the bond, the price of the bond that you own now is going down. So, there are winners and losers and all these things, and that's the thing. But what we're tracking on the F fund is the price of the bond. So as interest rates go up, the price of the bond goes down. So what this chart is telling me, which is completely counterintuitive, and we'll see what happens, but the chart is saying that inflation is not happening. Mm-hmm. While we see it in the price of gas and other things like that, the chart is indicating that rates are not going to go up.
At least not yet.
Yeah, no, at least not yet. I mean, I'm not making a call in any way.
I'm getting all bullish on the F fund.
No, I'm just saying that the charts look what they look like. That's all I'm saying.
Yeah.
All right.
Questions. As usual, if you have questions, send them to us. You can send them to us through email. Usually it's better to do it on the post that we put out on Facebook. So if you do it in the comment section, on YouTube, Facebook, wherever you find this thing.
You want to do it. Yep.
We'll do our best to answer it. And if it's a specific question to your circumstances, it's going to be hard for us to do that. But if it's general questions about the market and any of the, different educational tools that we talked about, we can definitely go into that stuff.
Next week is going to be a little weird. I'm going to be up in Boston freezing my tail off.
Is it going to be weird because you're in Boston?
Yeah, well, I'm going to have to put a little something together for the show, but we're not going to be in the podcast.
We won't be together.
Studio.
Yeah, we're not going to try to do two of us together at the same time, virtual, whatever, distance learning. We are going to get to that.
We're getting there, but we're not there yet.
But it's just too much to do. There's too many things that can fail. So what you're going to get is Jerry.
Yep.
And I will be, watching the news to see if anybody drowns in Boston.
Yeah, hopefully it won't be me. But the water's going to be cold, so if you haven't already contributed, thanks to the people that have. If you can support the Frogman Swim, it would be fantastic.
We'll throw a link in there again for the newsletter.
Yeah.
Most of you might have seen, the foundation that we're supporting. I won't go into all the details because there's going to be plenty of information coming in emails and on Facebook and, all that. But we'll save that for another time. We'll probably do a whole show on this partnership with this new foundation for suicide prevention for first responders and veterans. And with that said, hope everyone has had a safe weekend. And we'll see you next time. You're going to see Jerry next time.
Yeah, I'll see you next time. All right. I might be shivering, but you'll see me.
All right. And with that,
peace.
Deuces.